Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be covering stocks with X dividends next week, June 4th through the 8th. Now, I've been saying I've been wanting to write some more articles and make the very visual page on my website. So here I have written up this article. I'm going to be talking about 6 stocks with X dividends coming up next week. I screened 75 of them and got 6 out of them. 2 of these have been paying out dividends for more than 10 years. So, of course, if you are brand new to my channel, I do make stock market, real estate related investment videos. So, if you have not subscribed, go ahead and hit the subscribe button, hit the notification button, and let's go ahead and get started. So, actually, on my homepage, if you guys are interested in getting anything that I post over on my website via email, all you have to do is enter your email address in here. I have one other subscriber besides myself subscribe to my blog. So every time I create an article and release it publicly on my website, you're going to get an email. Let's see if I can pull up this email here. There it is. Okay, so it just sends you an email with the title new post. It's a new post with the X dividend 4th through the 8th. And I have 6 stocks. This kind of cut off my other stock here. Anyways, these all have price earnings ratio greater than 25, yields greater than 2, price earnings ratio less than 25, greater than 2% yields, rising revenue, net income, and free cash flow over the last 10 years. So you're going to get this article in the web in your email if you guys subscribe to my blog. And let's go ahead and just cover it from my website. I think it's a little bit nicer looking over there. So these are all ordered by X dividend date, so there's no number one. It's not like the best one out of the 6 here. These are all just labeled by X dividend dates, and all of these again had price earnings ratio less than 25, yields greater than 2%, rising revenue, net income, free cash flow over the last 10 years. Plus, at that point, I had like 12 stocks remaining out of the 75. I went a little bit further. I wanted to have stocks that had price to earnings ratio in the future less than it's currently sitting. So price to earnings ratio forward is expected to be less than what it's currently at. So let's go ahead and start off with number 1, ticker symbol ORI. Old Republic is an insurance company. It's operating in 3 segments: general insurance, mortgage guarantee, and title insurance groups. So the X dividend date is on the 4th of June, which is next Monday. So you got to buy this stock on Friday or prior to be eligible for the X dividend date. You would then get paid out on the 15th of June. So about 10 days after you buy the stock and hold it for the X dividend date, you would get your dividend payout. Now, over the last 10 years, you can see that this stock's price has risen about 10% average per year. It's at 107.3 over the last 10 years. Its revenue here in the orange is at 59.38% over the last 10 years. So that's about an average of 6% per year. That's not too bad. That's having some growth there. And its free cash flow is up currently 74.79%. But the major one here is the net income has been up 1.76 thousand percent over the last 10 years. So that hiccup that we had during the financial back in 2012, 2013, it did dip a little bit here, but look at the recovery and it just continued to climb. So very strong looking stock over just the past history here. Now as we move here down towards the bottom, the second graph is going to show us the current dividend payout. So they pay out 19 cents and half a cent, so 19.5, 19 cents and like a half a cent for each share. They're currently priced at $21.06. That gives them a yield of 3.63%, so that's a very good buy-in yield. Their currently price earnings ratio is 13.68, but they're expected in the future to go down to an 11.86, so they're expected to their earnings to grow in comparison to their price, which will drop their price earnings ratio a little bit less. And they're currently price to book value is at a 1.2. So ORI stock, when charted, it shows the current stock is a higher price to yield. Very close right there, which would indicate it may be overvalued at this time, or it could be a good buy. The stock is below the S&P 500 PE average of 25. It is sitting below 60% payout ratio and has dividend growth for 36 years. So this one I would consider has been recession proof. So it survived the 2008 recession, it survived the 2000 recession, and it survived the 92 recession. And not only did it survive and not cut those dividends, but it's continued to raise their dividends year over year over year for the last 36 years. This price to book value is also sitting at a 1.26, which is less than 3.0, where value investors would consider a value. So again, the stock is at a 13.68. The S&P 500 averages right around 25 right now. Dividend yield sits around 3.63, 3.7. Annualized payout, they pay 78 cents per share. If you divide 78 by 4, that gives you that 19.5. This little spike right here is showing that they had a special payout probably here in January to their shareholders. So it's very nice. Their payout ratio is at a 45.9, which is very healthy. And again, dividend growth for the last 36 years. Number 2 in ex-dividend is ticker symbol CSGS, which is the CSG Systems International. It's basically a business support solutions provider in the communications industry. That's as much information as I could find. I'm not too familiar with that company. The ex-dividend date is again on Monday. The payout date is on the 21st of June, so a little bit more, a little bit further the payout than the previous stock. Now again, this stock has had positive numbers here, so the stock price is actually up 206% over the last 10 years. So the stock, the price, the price of the stock, the stock of the price, no, yeah, the price of the stock has risen on average around 20% per year over the last 10 years. So it could be a little bit expensive right now. You can see it's been going up very high and then coming back. So you can see here, if you did the 200-day moving average, it's probably sitting right above it or right at it right now. Orange right here is the revenue, so very nice steady revenue increase of about 7 to 8% rise per year. In the green, we have the net income at 14.54. Not a very, their net income isn't growing year over year crazy, up over the last 10 years, about 1.4% average per year. And then in the red here, we have their free cash flow at 1.33%. So if you read over their past yearly 10Ks, their yearly reports, they probably show you what they're doing, they're spending on. Of course, during the 08 and the 2013, there was always that kind of a pullback, so maybe they use some of their free cash flow to pay out their shareholders. And then since then, maybe take a look as to why they've been paying out some of that free cash flow out and why it hasn't grown as much as some of the other stocks around it has. So it looks like they did increase their dividend here from roughly 19, a little bit below 19 cents, about 19.6. It's now at 21 cents per share. They're currently priced at $40.96. They have a yield of 1.96, so the yield is currently above the price. Their PE ratio is at a 24.53 right now. It's expected in the future to fall down to around 14.37, so that's a very big drop right there. And their price to book value is at a 3.84. So the CSGS stock, when charted, shows the current stock is a higher yield to price, which would indicate it may be undervalued at this time. The stock is below the S&P 500 price to earnings average of 25. It is sitting below 60% payout ratio, and that's dividend growth for the last 4 years. The price to book value is at a 3.84, which is greater than 3.0, where value investors would consider a value. So the stock is sitting at 24.53. S&P 500 average is 25. Again, that yield bounces around 1.96, 2.05 depending on the day, because of course when the price rises, the yield goes down. When the price falls, the yield goes up, and you get that, you lock in your yield when you buy the stock. Annualized payout is 84 cents per share. If you divide that by 4, it's 21 cents per share each quarter. Payout ratio is low at 34.9, and again, dividend growth for the last 4 years. And number 3 in ex-dividend dates, we have ticker symbol UVSP. Univest Corp in Pennsylvania provides commercial and retail banking services in Pennsylvania. It serves customers in Montgomery and Bucks counties and Pennsylvania through 34 banking offices. The ex-dividend date is 5 June, which is Tuesday, next Tuesday. So you got to buy the stock on Monday or prior for the ex-dividend or for the payout date on the 2nd of July. Now this stock has had, some very good free cash flow gains of 290% over the last 10 years. So recently, a lot of their earnings, their extra free cash flow has increased their reserves there. Their revenue is up 124%, so about 12% per year increase. We already covered free cash flow. Their price is only up 25.59% over the last 10 years. So this stock has really kind of came down since 2008 and really hasn't gone anywhere. So I see a lot of upside potential for the stock. You can see that its other numbers, its net income is up roughly 11% per year on average. Its revenue is up about 12% per year on average, and his free cash flow is up about 29% per year per average. So this stock sitting at a price average of around 2.55% increase per year over the last 10 years. There could be some growth potential here. Univest here, they're currently paying out 20 cents per share each quarter. They're currently priced at $29.10. You can see that the stock price does jump. It was up in the 30s for a while, and it's not that actually bad of a jump. It was in the $31 and some change, and now it's in the $29 and some change. So you can see that the bounce here within the year isn't that bad. If you buy on these dips, you could actually lock in a pretty good yield of 2.75%. And you can see the price earnings ratio right now, it is a 17.43. It's expected to fall in the future based off earnings to a 15.4. And his price to book value is currently sitting at a 1.4. So UVSP stock, when charted, it does show the current stock as a higher yield over price, which would indicate it may be undervalued at this time. The stock is below the S&P 500 average of 25. It is sitting below 60% payout ratio and has had dividend growth for the last year. Price to book value is at 1.41, which is lower than 3.0, where value investors would consider a value. So stock 17.43, average is 25 for the S&P. Yield sits around 2.75, 2.74 on a day, on a good day. The stock does seem to bounce here between 31 and some change and 26, 27 and some change there. They pay out 80 cents per share for the entire year. If you divide that by 4, that gives you that 20 cents per quarter for each share. Again, payout ratio 42.3 and only 1 year of dividend growth. So this would be one I'd be interested in kind of seeing why its price hasn't really moved up as much with the other with other companies and stocks out there in the market, and also take a look at its dividend growth. Has it locked it? Did it have to cut it? Did it have to cut it, etc. Number 4, we have ticker symbol WSBC. WesBanco operates as a holding company for WesBanco Bank Inc., which provides retail and corporate banking services in the United States. It accepts demand deposit, blah, blah, blah. Anyways, the ex-dividend date is on the 7th of June, which is next Thursday. So you got to buy this stock on Wednesday or prior to be eligible for the payout date on the 2nd of July. Now this one, it's all basically in the triple digits besides its revenue. So basically a 10% return per year on its price, its revenue, its free cash flow, and its net income. But of course, its net income is at the highest at basically 150% or 15% average per year. It's a very good looking stock right here, just very steady increase in price, net income, free cash flow, and revenue, which are all important factors. Here, they pay out 29 cents per share. You can see that they just increased it here after January. They did have it here around 26 cents. They bumped it up to 29 cents. So they probably bumped it up about 3 cents. That's about an 10% increase there. They're currently priced at $45.96. That gives them a yield of 2.33%. You can see that if you bought this stock back in September of 2017, the yield was above the price. You would have got this stock at a $35, $36 price tag. and you would have had a yield of around 2.7, 2.6, somewhere in that range right there. The price to earnings ratio is 19.81. In the future, is expected to fall due to earnings to 15.28. So this could be a good one here. The price to book value is at a 1.52. So when charted, it does show the current stock has a higher price to yield, which would indicate it may be overvalued at this time. The stock is below the S&P 500 average of 25, above the 60% payout ratio. That's incorrect. It's actually at a 38.5, so I got to change that. And dividend growth for the last 7 years. The price to book value is at a 1.52, which is lower than 3.0, where value investors would consider a value. So same information here that we covered right above. Payout ratio is actually at a 38.5, so it's actually at a healthy payout ratio. If they lost half their earnings, they would still be sitting at a payout ratio below 80%. So number 5, we have GPC, Genuine Parts Company, is chiefly a distributor of automotive replacement parts in the U.S., Canada, and Mexico. The company operates in 4 segments: automotive parts group, industrial parts group, office products group, and electrical and electronic materials group. The ex-dividend date is again next Thursday, the 7th of June, so you got to buy this one on Wednesday or prior, and then you would get paid out on the 2nd of July. Now this one has a bit of a curve here. You can see that it kind of peaked out in about 2015. It peaked, and its net income has came back a little bit, still up around 30% over the last 10 years. Free cash flow is up 50%. Free cash flow, they did fall a bit back in 2016 and 2015. It did fall there, so that would be something to kind of look. You can see that their numbers kind of changed here in 2015. So maybe they had very good free cash flow, but then they had to go into the reserves. Its price is up 106%, or about 10% average per year. So their price has gone up more than their other numbers here, which is, yeah, I like to see the price. Yeah, price is up more above its other growth numbers, but still good looking stock there. So oh, I didn't change the ticker symbol. WSBC. I may have. Okay, I gotta adjust that as well. Okay, so here we're talking about GPC. When charted, it does show the current stock has a higher yield to price at a 3.04 in comparison to its $90.34 price. It has a dividend payout of 72 cents per share. Its price to earnings is currently sitting at 20.96. It's expected to fall to a 16.02 and has a price to book value of 3.77, which has declined since the beginning of the year. The current stock we've already covered, yield over price. It may indicate it may be undervalued at this time. The stock is below the S&P 500 average of 25. It is sitting below the payout ratio of 60%. And has had dividend growth for 61 years. So this one is highly recession proof. So it has been really recession proof over the multiple recessions. Its price to book value again is at a 3.77, which is greater than 3.0, but there's a lot of stocks out there that have a price to book value way above 3.0 that investors still invest in. So price to earnings, PE ratio, we've already covered it. S&P 500 on 25. So this one, it does kind of trade kind of wild here. You can see the dividend yield can be sitting at a 3.19 today because of the drop in the market today. All the stocks across the market kind of fell on Tuesday, so this could be a good buying opportunity. You can see that the stock did peak out over $100. It probably was up to $105 before falling down to $90. They pay out $2.88 per share for the entire year, or 72 cents per share each quarter. The payout ratio is at a 51% dividend growth for the last 61 years. So very good looking stock. And then number 6, we have ticker symbol IR. Ingersoll Rand engages in the design, manufacture, sale, and service of a diverse portfolio of industrial and commercial products in the United States and internationally. So they do refrigeration, heating, ventilation, and HVAC solutions. Ex-dividend date is again on Thursday, the 7th of June. You would then get paid out on the 29th of June. So rising price up 372% over the last 10 years. So it averages around 37% each year. The net income is up 188%, or around 18% average per year. Its free cash flow is up 68.8% over the last 10 years. And its revenue is up 4.18%. So while its revenue hasn't really grown that much over the last 10 years, its net income has grown, its free cash flow has grown, net income has grown, and its price has grown by a large amount in comparison. This could be just due to the housing boom. I mean, imagine having a company that delivers refrigeration, it has heating, ventilation, and HVAC units, and the housing market's been crazy over the last several years here. So ticker symbol IR, when charted, shows the current stock has a higher yield over price right now. It has a 1.97 yield, and the price is currently at 88.83, which may indicate it may be undervalued at this time. The stock is below the S&P 500 average of 25, below 60% payout ratio, sitting at a 34% payout ratio. Dividend growth for the last 7 years, its price to book value is 3.11, which is greater than 3.0, where value investors would consider is value. So again, dividend yield sits around 1.97 to 2.03, depending on the day and when you buy it. Annualized payout $1.80 per share, or divided by 4, you get 45 cents per share each quarter. Payout ratio is at a healthy 34%. Dividend growth for the last 7 years. So that is basically it. Those are the 6 stocks that we covered today. We covered them in 21 minutes, so we did beat our normal time where we got to screen everything. So this actually gives us a lot more information. 10 years of history, a year of its, what its financial metrics are looking like right now, and you kind of give us a really good idea of, where the company is moving, where it's kind of going. But of course, if you want to do a deeper dive, go look at its balance sheet, go look at its last couple quarterly reports, go look over the last 5 to 10 years of yearly reports to give you a better idea. But for the most part, these are very strong looking healthy companies. So again, ticker symbol ORI, Old Republic. Ticker symbol CSGS, CSG Systems International. Ticker symbol UVSP, Univest Corp of Pennsylvania. Ticker symbol WSBC, Westbanco. Ticker symbol GPC, Genuine Parts Company. And ticker symbol IR, Ingersoll Rand. Those are the 6 stocks with ex-dividends next week that all have price earnings ratio less than 25, yields over 2%, rising revenue, net income, and free cash flow over the last 10 years, and they're expected in the future to have a lower price earnings ratio, which means that their earnings are expected to grow over the next following quarters in the future. So of course, if you have enjoyed this video, or this article, go ahead and like the video. Remember to leave a comment if you enjoyed the video. If you have any questions about anything that was covered today, go ahead and let me know in the comment section below. I always appreciate your guys' comments, whether they're positive or negative. If there's something that could be improved, go ahead and let me know in the comment section below. And of course, as a friendly disclaimer, I'm not a financial advisor or tax professional or any other professional of any sorts. The information provided is my opinion for entertainment and fun. This is just me as a financial investor myself, trying to help others make their money work for them. And that is it for this video. I thank you guys for tuning in. I will see you next time. Have a great day. Bye.